You're new to the Fed. What is your reaction function going to be? What's going to determine for you when it's the appropriate time to move interest rates again?
Well, so being new to the Fed, I've now been to 3 FOMC meetings, about to do my 4th in January. I've gotten a much better feeling, gotten to know all the other bank presidents, gotten to know the governors, a much better feeling, understand how the process works, and spent an enormous amount of time in this district and with our economics team here and economists throughout our system. And so the main things I'm looking at are unemployment, path of GDP, and again, evidence that we're moving toward meeting our 2% inflation target. And so those are the factors I'll be watching regularly. And so in thinking about the path of normalization, the other thing I'm sensitive to is running zero interest rates or near zero interest rates as we have is not free. There's a cost to it. It creates distortions in investment hiring and creates other imbalances. So I'll be looking for those also. But I'm going to be looking at GDP, unemployment, inflation, and trying to understand what's going on around the world and what the future looks like. But I have a bias toward thinking that if we can normalize, it would be much better to normalize because we've gotten so used to these potential distortions, I don't even think we recognize them anymore. And I'm sensitive to the fact that we want to get on a more normal footing if we can.
Well, do you have numerical targets for these metrics?
Well, sure. For GDP, basically, I want to see that in 2016, for example, we're going to be between 2–2.5%. That's our forecast. I want to see the unemployment rate continue to drop down. Our own view here is it takes about 100 to 150,000 jobs a month to keep the unemployment rate constant. I'd like to see monthly job growth beyond that level. And I do want to see some evidence we'll be looking for that after some of these transitory factors have passed with oil and the dollar, that we're gradually moving toward reaching our 2% inflation target, not this year, but over the next 2 or 3 years. So those are things we're going to be looking for. And in addition, we're going to be looking at economic activity all over the world and how it might affect what's going on here.
Do you think that those metrics will justify the 4 rate increases that the Fed's SEP suggests would come this year?
Too soon to say. You know, in December, you're referring to all the projections we made. I think if I thought we were making progress on all those indices that I just talked about, then I think that 3 or 4, something in there is a reasonable base case. But the economy never unfolds quite as you expect, and so we're going to have to just assess conditions and adapt to it. But I think if we saw progress along those fronts, for me, I would have a bias to want to move toward normalization, understanding there's always going to be a lot of pushback and a lot of resistance to doing that because it comes with some risk. Every time we increase the Fed funds rate, we're going to need to watch and see what the impact is. A lot has been discussed about capital flows moving away from emerging market economies because of what we're doing, strength of the dollar, impact on our exporters. So we're going to have to watch and learn as we act, and I'm going to be very focused on doing that, not predetermine what we're going to do or be too Calvinistic about it.
Speaking of the economy not unfolding as somebody might have predicted, you're in the middle of the oil patch.
Yeah.
Nobody thought we'd see oil around $30 a barrel. What's the impact?
The impact on this state, I think the mayor who you just interviewed talked about the fact Dallas has been very resilient. Austin has been very resilient. Houston is much more negatively affected. But the net impact of all this statewide is that job growth is still up in the state, which is a testament to the resilience of the state of Texas. Much more diversified state, but it's still much lower job growth than we had, say, in 2014. To give you some numbers, job growth here was about 3.6%. In 2014, it was about 1.25%, 1.3% this year, and we think it's going to be about the same in 2016. So it has slowed job growth.
Well, we have had an impact on job growth nationwide and also on CapEx.
Yeah.
Are there other areas that you worry about?
Well, so there's two impacts of lower oil prices. One is the immediate effect of cuts in capital spending, and that's hurting. We're seeing that in companies. We're seeing it in the state. But there's the positive effect of lower prices for consumers, more driving activity, better car sales, most likely because of that, greater ability to spend on other things. But I do worry about the ripple effects of what's going on in the energy sector. For example, one of them is energy is a material part of the high yield sector. High yield issuance in the last 5 years has gone up dramatically. And what happens because high yield bonds are held in mutual fund now today in ETF form, if you have a weakness in one sector, it tends to cause selling in every other high yield sector because of fear of redemptions and actual redemptions. And so I do worry that some of the things that are going on in the energy sector are making it harder for companies that are leveraged to borrow, and it will widen credit spreads, and it's having that effect already.